Okay, good morning, everyone, and welcome to day 2 of DebtCon. I'm Rosa Lastra, and I'm Sir John Lugoff Chair in Banking Law, Queen Mary University of London. I'm also the co-director of the Sovereign Debt Forum together with Anna Gelben. And for those of you that have not heard enough, it's one of the co-sponsors of DebtCon. The Sovereign Debt Forum is an academic enterprise or venture between Georgetown University and the University of London, which is co-directed by Anna Gelben and myself. And we have a number of affiliated scholars and institutions, including the European University Institute, Hugo Panizza. The idea of the forum came from Lee Buchheit, known to many of you, if not all of you. And we wanted to establish to do research as well as capacity building, particularly focused on the low-income countries and advising sometimes with regard to events, with regard to different training sessions or various instruments with regard to debt management, debt restructuring, which is at the very core of what we're doing today. We are very, very grateful to have this. We have an official sector consultative group, which includes the multilateral IMF, World Bank, several regional banks, and a number of institutions. So we're very pleased to have the support. That means the finance will be wonderful. I can see Leonie here. Throughout our years since we were funded, we have done a lot of things during the pandemic. The support of the Dutch ministry has been fantastic. But on to the session of today, we have 3 parallel sessions. In a way, I want to be in the other sessions too. I do research with Dan Bradwell, so I am sad that we cannot have a divine property of being in several places at the same time. But I am, of course, delighted to be here in this session because it's really a very, very important subject. It's a very important theme. It's a very important topic, and one in which many of you have either a research interest, a policy interest, a practitioner interest, an academic interest. And it is how much the universe of creditors has changed. The dispersion of creditors is the name of the session. And it just, we were all, or we're all experts in the room. But it really has changed a lot. If you go back to the 1970s, really the creditors were mostly multilateral, so official creditors. Then in the 1970s, we had the commercial banks coming into the picture. And and of course, with the commercial banks, the main instrument, the syndicated loans. And then with the debt crisis and the restructuring of the debt in the 1980s, we had then the Brady plan, and then we had the bond instruments coming into the picture, and again, a very diverse. And then we managed to get to hold with the bondholders, how to deal with them, with the advent, with the generalized embracement of collective action clauses in the many variations. And we have a paper today that is specifically focuses on that. But again, today is different, and we have entered a little bit of the unknown. We have, besides Paris, of course, and the common framework, an attempt to have some sort of parity, but we have China, we have, bilateral lending at the digital level, we have trade credit, we have a very diverse universe. So not only the papers are very interesting, which they are, but I expect that during the session, and we have a little bit of an expanded session of Q&A, because unfortunately or fortunately for you, the 4th paper will not be presented. The Sub-Saharan paper, unfortunately, the presenters of the paper cannot be with us today. I would have loved to hear about lending diversification in Sub-Saharan countries, but you have to be without that paper. So we will have hopefully more time so make sure as you listen to the papers, or as you have questions, either to me or to the panelists, that we can discuss them properly during the Q&A. So without further ado, so is my role as chair to try to spice up a little discussion and put the subject into context. But without further ado, we will start with the first paper, which is a co-author paper. And I understand that the presenter is going to be Clemens, Graf von Luckner. I hope I pronounce it well. My very limited German. And then Sebastien, who will be joining online. Clemens has been working with Carmen Reinhardt and Stéphane Guibaud on the subject related to sovereign debt. But I think that you've also done work on other areas, including central bank digital currencies and other areas anyway. But today he comes with his hat at sovereign debt, and the paper that they will be presented is a generic paper on credit dispersions in sovereign debt markets. I will reserve a few comments for when we open up the discussion, and I will invite Sebastien, who is joining us online, who's an economist at the World Bank and has been previously at the Kennedy School of Government in Harvard and at the Heath Institute, and he's joining us online together with others. But Clemens will be presenting the paper, and the floor is all yours. Thank you very much for presenting the paper and for being with us today.
Excellent. Thank you so much. Yeah, sounds a bit like a generic title. We haven't found something much sexier just yet. So this is work in progress together with Sebastien. And we're really just looking at the idea of creditor dispersion in sovereign debt markets. Now, I'm not sure how much I need to motivate this question in front of this audience, so I'll try anyways. As you know, this week, Zambia finally got to conclusion of its debt restructuring, at least the second to last step. When we met here a year ago, we already thought we're nearly there. Then we met a bit later in Paris, so a lot of us, and we found, okay, now it's really the time that we made it, and yes, it took still longer and longer. Why? Because different creditors just couldn't come to a deal that everybody could agree with. We've heard a lot about that. Lazard has summarized this quite neatly, I think, in a paper where they said, with a large variety of creditors, it seems impossible to get an expeditious process, sufficient debt relief, and equity amongst creditors. As a result, debt restructuring processes stall. Now, that in itself has actually been studied quite a bit. We know that coordination problems lead to longer debt restructurings, or at least so is the assumption. And we know that generally causes welfare costs. But it hasn't been studied so much is why countries actually borrow from many creditors. What sort of drives the idea that you need to have many creditors? Why do you not just go to one very big bank and always keep borrowing from that? And then if something goes south, then you can restructure maybe quite easily because there won't be any coordination problems. And this is somewhat of a surprising blind spot because in the corporate finance literature, this is actually found quite a lot of attention. Now, one of the reasons why this hasn't been studied so much in the sovereign debt space is because the data just wasn't there to look at sort of the microstructure of the creditors in this space. The contribution that we want to make with this paper is that we present a new data set on creditor structure of sovereign debt. So we have a micro loan, like a microstructure that's essentially the loan level of all sovereign debt since 1970. And we established two style aspects. First, I'll call them style aspects. So now we're working right now to sort of make this a bit stronger, but like for now, we'll just stick to that. First, maybe the more expected one is that higher creditor dispersion is indeed associated with more costly debt restructurings across the board of indicators. So this is the duration to restructure, but also the haircuts that sovereigns get. And the second one is a little less known, which is that we find that creditor dispersion actually increases as default risks increase. We then develop a little theory. I'm going to go into that a lot less today, but essentially the idea here is that we try to find a model that sort of can explain these two side aspects and bring them together, because as I'll highlight, they are a little bit contradictory. And we essentially highlight that it could in fact be that creditor dispersion can be a tool that sovereigns could use strategically to sort of essentially communicate their commitment to repayment of their debt, because you essentially know that the defaults are much more costly if you have a very dispersed creditor base. I'll go into that in a second. So what is this new data set on the microstructure of sovereign debt? What we used to make this analysis is essentially a confidential and previously unused data set that is the underlying data of what many of us know, which is the World Bank's DRS. So the World Bank's DRS gets the data from all the governments around the world who need to borrow from either the IMF or the World Bank. They need to, essentially the DMOs need to, if they want to maintain a good standing with the World Bank or the IMF, they need to submit every year, in March, all the contracts, or all the information about the contracts for long-term debt, that is any debt contract that has a maturity of more than 1 year, to the World Bank, and the World Bank accumulates that and then publishes the aggregates in their DRS that we've been looking at. That means in this data set of 123 emerging markets, or sovereigns since 1970, we have just under 220,000 loans or public debt instruments. We have the information on the amounts issued, the outstanding amounts, as well as financial terms, so interest rates, grace periods, and the time to maturities. Importantly, we also have some information on the creditors, and that's what we're going to rely on most in this exercise today. What we then do with this data, and that's sort of taken the longest time in this analysis, that anyone who worked with IES data, they know that data is a little bit noisy. So one thing that we have spent a lot of time on is cleaning the data and then identifying and consolidating creditor entities. What do we mean by that? if we want to actually know from how many creditors a sovereign borrows, we shouldn't be counting World Bank MIGA and World Bank IFC as separate. At least in our eyes, those should essentially be accounted as one because there isn't any sort of coordination problems between the different funds of the same creditors. So that's some of the work that we did for all of these debt instruments to arrive at sort of a clean data set on the information on who sovereigns borrow from. Here's a few sort of just descriptive statistics to give you a bit of a flavor of what this data then looks like. We find that in total, these countries that we cover have borrowed from 1,900 banks, 500 bilateral entities. So you see already that actually exceeds sovereigns that exist in the world by quite a bit. But we do think that there is, in some cases, coordination problems between different bilateral creditors. So you might be borrowing from the KfW and GIZ in Germany, but they are actually sort of competing to some extent. And so they actually also have coordination problems among themselves. So we don't consolidate at that level. We have 70 multilateral creditors, 6,500 trade credit providers. That makes sense because many of these companies are essentially just suppliers. And then 1,700 bond issues. So we do not look at bondholders at that level, but only at the bonds. This is sort of the main shortcoming of this data at this point. Some of the empirics. So the first question that we asked is essentially, so how does the creditor dispersion actually affect the outcomes of a debt restructuring? In today's world, we would say, well, very clearly, having more creditors must take longer to restructure because they have coordination problems. But if you talk to an economist back in the 1970s, 80s, they might actually say, no, it's actually the other way around, because if you have very few creditors, they can't take the losses. In the 80s, one of the big problems that prolonged debt crisis was actually, or at least that's often cited, is the idea that banks couldn't take the loss, and so they had to sort of kick the can down the road until they had the reserves to absorb the losses from the restructuring, right? So these are sort of two theories that could say either more creditors are good to make for a quick restructuring, or less creditors are good to make for a quick restructuring. So I think it's still nonetheless an interesting question. We basically look at the creditor counts on the one hand, and then outcomes of restructurings on the other. As sort of a robustness check, we also look at Herfindahl indexes, where we also take into account the concentration of the debt, sort of detail. So the first aspect that we find is that indeed today's theory is sort of the one that is dominant in the data. Higher creditor dispersion is associated with more costly debt restructurings. When dispersion is high, debt restructurings take longer, yield less debt relief, and are more likely to occur post-default. What we do there is basically look at data from so default spells from Asunu and Trevish, and a joint work with Josephine Meyer this year, and Carmen Reinhardt and Christoph Trevish as well. And we compare these restructuring outcomes. So now just like look at the correlations with that and the creditor counts before the default occurred. First thing that we see is that any additional creditor on average reduces the haircut that a sovereign achieves by around 0.34%. It reduces the probability that we manage to get a preemptive restructuring. This also makes sense, right? Because for preemptive restructuring, you need to get creditors to agree very quickly, usually because you're running up to a deadline. So that makes a lot of sense intuitively. When we look at the default spells instead, we find that when you have very, very many creditors, you need more restructurings to end the spell. That is sort of the story that, you do a couple of shallow restructurings until you actually achieve that sustainability. And then finally, it increases the duration of the default spell altogether because you just take longer to come to a solution. For any additional creditor, it's around half a month. So the style aspect, one is sort of the first empirical information of predictions by theoretical literature on the coordination problems, and those actually being very costly, and sort of shows that the coordination seems to outweigh its potential value at risk channel that many people have cited for the 1980s, at least in this episode. The results sort of suggest that sovereigns, when they face incentives to consolidate, when they would restructure, right? Because if you think that this is causal, then you would say, okay, well, I'm about to default because I'm running short of money. I should start sort of getting rid of creditors on the margin, maybe still pay them up with the little money that I have, so the restructuring becomes easier. In fact, however, what we see is that exactly the opposite happens. In fact, sovereign creditor dispersion increases as default increases. Here we show this sort of graphically. We look at the default event that happened, and we look at the creditor dispersion in the 10 years before. And you see this very stark increase in both creditor counts and Herfindahl index of creditor dispersion in the run-up to the default, right? If we look at this in a regression framework, you would just use the legs of sovereign risk ratings to sort of get rid of some of that endogeneity. And we essentially find that first, across the whole universe of observations, if you have a higher credit rating, generally that's associated with more creditors. But that's only the case because obviously if you have a higher credit rating, you can borrow more, and so generally your creditor base is wider. Once we add country fixed effects, so that means we only focus on the time variations, all these things change over time, we find that the sign exactly switches over, and that's what we basically saw in this graph here. And the sizes of these correlations are quite sizable.
Sorry, Clemens,
Yeah.
how do you count bonds then? Can you say that?
Good point. So this will be interesting with the presentation coming right after. We essentially make the assumption at this point that a bond contract is the same as a loan contract because there's one contract. We don't really care who holds those bonds. One creditor. That is sort of like takes the contractual view. Of course, from today's point of view, we might say, okay, that's not quite the case. But the fact is that it's the exception that you have hold of credit. But in most cases, if you have one bond, the people of those bonds usually come to the same deal. It's a strong assumption that we have to take at this point because we just don't have the data on the holdings. It's something that we're working on to improve at least to some extent, but it will never completely get the universe there because the data just doesn't exist. So again, showing this result essentially graphically, as you see, as the sovereign ratings increase, you would change these into numerical values. We have an increase in that increases with the mean creditor count of these countries. However, once we add those fixed effects, the slope exactly switches over. And this is essentially this sort of anti-intuitive result that we're highlighting here. So putting those two together, that is sort of a contradiction or a bit of a puzzle. On the one hand, we know that the higher dispersion actually makes debt restructurings more costly. On the other hand, right when debt restructurings become likely, sovereigns actually increase their creditor dispersion. It's this sort of contradiction that motivates us looking into a bit of a model. We can find a mechanism that could explain both of these factors. I'm going to go over this very intuitively because I sort of mindful of the sort of heterogeneity in the audience. I'm not going to go through sort of the details of how we set this up in the model. I'm very happy to discuss that with anyone interested to also get some comments on that. But I'm going to go over it sort of to just present the intuition of it. Essentially, the idea is that unlike in the sort of standard models of sovereign default, where the creditor structure is essentially treated as irrelevant or as exogenous, we actually add that explicitly as a policy variable to the model that is sort of in line with what has been done in the corporate finance literature until very recently. And then we investigate sort of what channels that triggers in the model. Essentially, give you the intuition of the model. And for those that are not as familiar with this, in the Ariano-style models, which are built on the Gerstovitz models earlier on, is basically the idea that governments are there to maximize the population's welfare by borrowing to smooth consumption. Every period, the government decides whether to default or to repay. When it chooses to repay, it does so by rolling over the existing debt as an interest rate, which reflects the probability of default in future periods. In case of default, that comes with some costs. So growth is depressed. The government is excluded from markets for a stochastically set period. And we're going to talk exactly about this because we've seen just now that, right, when you have more creditors, the period to re-access markets lasts longer. So this is exactly one of the channels that we are tapping when we are adjusting this model. And then the decision to default or repay is based essentially on comparing the value functions of these two outcomes, taking into account the future realizations in both of them. What we change is that essentially we let the government not only choose the amount to borrow, but we also let the government choose how many creditors it borrows from. So that means that the cost of default becomes dependent on the creditor count because more creditors mean longer defaults.
Default or negative values, both against you.
Yeah, we do not. We work on this sort of work with the baseline model, the 2008 model essentially, not the partial default. Very, very important. To sort of parameterize the effect of additional creditors on the default duration, we just use our data because we have that there, so it's sort of very simple to do. And then by that sort of give the government an additional tool with which it can affect the interest rate. Before, a government can only affect the interest rate really by borrowing less, which it can't really choose much because it has to repay all debt. Now, in this variation of the model, the government at any point in time can actually change the interest rate a little bit. Why? Because if I'm about to I want to repay my debt, I can choose to borrow from very many creditors because that affects the probability of default. Why? Because in the next period, the creditors know if I were to default in the next period, it'll be much more costly to do that on a very broad creditor base than to do it on a very narrow creditor base. So given the amount of debt that I'm taking on from the markets, if I take it from very many creditors, I'm signaling to my creditors that I'm more likely to repay, because in the next period, when I have to make this decision, the default will be much more costly. This is sort of the functional form. I'm just going to skip over this for people who are like very familiar with the setup, but essentially just give you the intuition is we add these creditor counts. It's very simple and like it's really a minimal adjustment, and we just add a little inconvenience of only adding more creditors, which makes sense because if you have more creditors, that's a debt management cost, right? You have to manage them. To give you a bit of an idea of how this then affects on what the side effects are in sort of the very baseline setup of an Ariane model, what we see here is the bond price schedule as a function of the debt stock that you're taking on. So essentially, you choose to borrow 40% of GDP, then the bond price, so it's the inverse of the interest that you will be paying, drops to fairly low. But at any point of the schedule, you can increase the price by just increasing the number of creditors. And this is true this is basically for a high outcome scenario. So essentially you have high GDP draw in time. If it's a low GDP draw in time, you see that it sort of affects the curves regardless. So this is, I think, a bit of a steep story, right? Because in some sense, when we first tried this, I was like, okay, it makes sense, it's neat, it explains the two style aspects, but do we really believe this? Do we actually think that governments go out and say, okay, I'm going to try to signal to the market, or is it just sort of, it's an outcome without the implicit or the explicit desire to do this? We then, as we thought about this, and it's just a little bit of a piece of anecdotal evidence, there was this interesting incident a few months ago when Egypt seemed to have done sort of that, when all of a sudden they like went all over the news and went rather than before, when people borrowed from China or Asia, they kept it sort of quietly. All of a sudden they went like, oh no, we have this new panda bond, and they're like celebrated it like crazy. It was like, okay, so is this part of the story that sort of fits this, or are we just looking at something else? But of course, anecdotal evidence is only so useful. So we thought about another way to get a little bit of empirical support to the strategic dispersion channel. The key idea here is that we said, okay, well, if the creditor structure is a commitment advice, then surges in creditor dispersion under the stress should be driven only by borrowing from creditors, which are particularly likely to cause coordination problems, right? So if you're basically trying to show, yeah, I'm complicating my creditor structure here to make default more costly, I'm not going to be borrowing from very cooperative creditors. I'm borrowing from the creditors that are not cooperative. So we exploit the granularity of the data that we have, and then study the two style aspects, but by separating out these different creditor types and see if they actually differ. First thing that we see is that indeed the first style aspect is driven very much by private creditors. This makes a lot of sense because again, from today's perspective, we'd say, oh, but China, but like in most of this data, we need to remember that China didn't exist as a creditor, right, over the largest period of this data set. So what we see then is essentially that over this period, at least the private creditors are the ones that are driving this result, that more creditors are associated with longer default spells. Particularly if we split it up even more, we see that it's the suppliers and the bank bond creditors, and all the other creditors are essentially irrelevant. There's just noise in this correlation. There's no statistically significant correlation at all. Our model would predict then that the sovereigns, when they sort of disperse their creditor base before default, they should particularly borrow from exactly these creditors, right? And that's exactly that we see here. When we split, remember this regression table from before, we split up this regression table into the different types of creditors, and we see that indeed here the correlations are much, much stronger for private creditors than for the bilaterals and multilaterals. And so that essentially at least fits the story that we're telling. I'm not saying this is the sort of makes it irrefutable, but I think it sort of works in line with the channel that the model highlights, which Whitney thought was quite interesting. I'm going to conclude. I'm not going to go over the effects again. The presentation was short. I'm sure you remember. I'm happy to discuss those and get your thoughts, because this is really, really early research and we're just sort of trying to wrap our head around this. Some of the next steps is we need to calibrate this model with in different scenarios to get sort of some simulation out of it and see if that actually fits the data as well. And then we're working on sort of turning these style effects into stronger essential causal results by working with some exogenous variation. And sometimes series strategies to sort of make these findings a little bit stronger still. But those are sort of our next steps. If you have any other suggestions, we're very happy to hear them. And thank you so much for your attention.
you very much, both for an excellent presentation and also for staying in the timing. So what we're going to do, you want the question right away? Yeah, please do.
Are we doing questions?
No, but we were going to do questions at the end, but if you have one right away, the stage, please.
Yeah,
We have time.
don't mind, Clemens. Thanks for a very good presentation. It looks like a very interesting paper. So I wonder, in your theoretical framework, have you taken in like exposure limits, anything with that among the creditors? I very much a practitioner, so I've worked quite recently on the case of Uganda, where they're now borrowing quite a lot, and essentially the traditional syndicated lenders, Standard Chartered, Standard Bank, I think they've essentially said, we're not lending more to you, so you're going to have to, and they've more or less been forced to go to other lenders. So that's the primary driver of why you see this dispersion of the creditors. And I think that's, I mean, to me, from a practical perspective, that seems a stronger driver. I don't think that very many, I think these debtors are aware of the default, but I think there's very much the focus is on the near term, getting money quickly. And I think if you want to signal that you're not going to default, it's more likely that you're actually going to cut back your spending. And then also from the kind of lender borrower perspective is, of course, if you have a more concentrated set of borrowers, then they can exert more pressure on you to, extend funds. Well, that's a way to get away from it by expanding your credit events.
I'll take few.
There are two more, which we will take. Let's take it, can be foremost, and then the rest will be for the end. So one. Okay, you go second.
Thanks for the presentation. It's kind of a similar question. How do we differentiate the signaling effect with a more simpler assumption of the borrower will rank the potential creditors with conditionalities and costs very simplistically? And as the default nears, many of the good creditors, they just are not available anymore. And so you turn towards like the guys that will provide bridge financing, the bilaterals that will ask for collateral, the common traders that will provide like last resort kind of financing. And so that's how the diversification like just kind of arrives and you don't have another option.
And then one more, and then you take, that was in the back, and then we'll take them by already. You?
My name is Ismaila from Boston University. I think also in the same direction. My first question is empirical. So when you see the dispersion of the when countries are going to default, to which creditors do you see exactly? I think, do you include AMF credits, or you are only looking to the list that you presented? My second question is, I missed a little bit. You're analyzing a market, but you're only taking the demand side, right? So what about the story of, borrowers, lenders choose not to lend? So I feel that is a missing story. You're telling a market story, but you're only looking to the lending demand, to the demand without looking to the supply.
Excellent.
Yes.
So actually, I think they're very somewhat closely linked. In the version of I presented this a few weeks ago in Cambridge, and so in the paper, actually, there's a second channel that we highlight. We call it the supply and the demand channel. I find the demand channel a little bit more anti-intuitive, so I wanted to focus on that one because it's more provocative. The other one is, of course, also true. The moment where you take an Ariano model and instead of having risk-neutral investors, you include risk-averse investors, that's a super tiny adjustment in the model, you immediately find that it's actually better to increase your creditor count in certain moments of time. So that's definitely true, and it's something that we do in the paper as well. It's kind of like less spectacular and less provocative, so I sort of talked about it, but that's of course right. So there's the supply channel, and I think the whole idea here is that we're not trying to say, oh, this is the only thing. We're just trying to highlight like this could be part of the story, and it's an interesting thing that hasn't been highlighted before, and not at all to say, okay, this is all that sovereigns do, and this is the only thing that drives the dispersion. And then the other question on what defaults do we actually look at and what the creditor, we exclude the IMF from the start because sort of super senior creditors are uninteresting in this context. So that's how we split them up. And then on the defaults, we actually focus on this one thing that's important on private sector defaults, because for us, that's sort of your default on a private sector creditor is sort of the as the mother of all defaults, right? Because you might be restructuring with a bilateral because you have a political deal with them too. That's not always even distress driven. Once you default on private equity creditors, you're also restructuring your bilaterals. Those things always concept. And so that's what we focus on, sort of the first instance. Thank you.
And then I have a question here and here, which I will take, yeah.
And this thing with the bonds, that you need to bundle and you really don't know. But I mean, like can you separate this bond by the market of issuance, the currency? So like, I mean, like Japanese bond is held by Japanese investors, that the Lira bond from the 80s is held by pensioners in Italy. So, I mean, maybe then you have some way of unpacking a little bit all those bondholders that way. And I don't know if you can maybe tell us something about like this increasing dispersion as default approaches, because I mean, I think it's simply natural. And I'm just thinking there about the role of regional financing agreements, the IMF, the credit facilities by the World Bank, the COSINs. So all this kind of support, because you are entering into stress, this must generate a lot of diversification. And then it's of a kind that I don't know if it is more expensive, but that is for sure very hard to restructure and probably generating issues in better restructuring going forward, because this is senior lending for crisis support. But I don't know what is the role of that in this question.
Yeah. And the last question now, then you can take more in the paper at the end, yes.
Thank you very much. So you highlight that there are kind of two kinds of creditors, like the smart ones that we kind of get out at some point, and then the ones that are likely to cause trouble. I was wondering, presumably they are strategic as well. Presumably they know that like lending to these kind of debtors will lead to more difficult restructuring outcomes down the road. Why would they participate? Question number two, awesome data. How did you get it? And will it be publicly available after you publish it?
Okay, I'm going to start with on the question of the bonds. And so we already do split them in different bond issuances. And so if there's a Lira bond and a bond in Japanese yen, those will already be separate creditors in our case, but we won't split them by, say, the bond that is issued in Italy, half held by this pension fund and half by, or one bond each by people who have bought them privately. So we don't know this sort of disparity now. That is, of course, part of the story, as we've learned in the Argentine case. On the other question on the multilaterals, it's actually interesting, but the multilaterals, at least not, I mean, we think of the World Bank and IMF, but there's many, right? There's around 70, and many of them are very pro-cyclical. They actually have sort of this positive correlation with some risk. And so we show it, we were surprised to see that too, but the people who actually come in when the stress rises is the privates, not the multilaterals, because the multilaterals are, in many of these cases, already there by that point, right? So you go through a few rounds of sort of bridge loans, and like it's the Ghana story, right? So like in 2017, you're close to default and you have lots of multilaterals that lend and bail you out essentially. And then you have all of those credits already by the time that you actually default because they're not there anymore. So that line is going to be flat at that point.
That is our thing. I mean, the role of the IMF with goes anywhere is to bring co-financing from the official sector. So I would expect that the moment you with the IMF, you get 50 creditors more.
But we find that it's actually not driven by the bilateral, but by the private sector, right? So that's that. On this good and bad, I wouldn't go there because it's not really clear what's actually the optimal strategy. For that, we'd have to look at the returns that the different creditors make, good and bad in the sense of like smart or not smart. So it's very hard to make that distinction, and so we don't go there. On the data,
Actually, you did say like I'm going to borrow more from creditors that are more likely to cause trouble later on.
Okay, so but cause make lead to coordination problems, right? So like that's not
trouble later on. Yes.
Yeah. But them causing trouble. I mean, I'm going to take a stance here. If I was working for a hedge fund, I would be like, these are people that enforce the rule of law, right? So like this is not bad. And on the last point, I'd love to make it available. That's a battle we have to take up with the World Bank, but I'm standing out there with you for this thing.
Okay. So now we go into the second paper. Thank you so much. The second paper, the 2018, is the aggregation dilemma. How best to restructure sovereign bonds, and it's a paper that is presented authored by Stéphane Guibaud, who is professor of economics in Sciences Po, and Carlo Galli, who is assistant professor of economics at Universidad Carlos. And it's a fascinating analysis. I'm sure all of you have read it, an economic analysis of collective action clauses and the optimal use of enhanced collective action clauses by a sovereign seeking to restructure multiple bonds at minimum cost. And actually, he takes into account, coming back to the first question, both the diversification of bondholders and the diversification of bond instruments in terms of their model. So the floor is all yours.
Thank you very much, Rosa. I don't need to present anymore, content of the paper. So this is joint work with Carlo, who is in the room, and we're going to zoom in on the heterogeneity of bondholders, like within bond period and across bonds in this paper. Okay, so this paper about collective action clauses, in the very unlikely event that someone in the room doesn't know everything about CAC already. Those are contractual provisions that are inserted within sovereign bonds that provide that in the event of a restructuring, the approval of a restructuring plan by a supermajority of bondholders binds any dissenting minority to the terms of the restructuring plan. The idea, of course, is to alleviate any potential holdout problem in sovereign debt workout. The exact formulation of collective action clauses has evolved over time. Since 2015, most new issues of the international bonds issued by emerging market sovereigns incorporate the so-called enhanced version of CACs. And what's going to be of interest for us in this paper is what those enhanced version of CACs had to say about the restructuring that involves multiple series of bonds, which is very often the case if you think of a country that has different series of bonds out there that may differ typically in terms of their maturity. What enhanced CACs say is that at the time of the restructuring, the sovereign will be able to put forth a restructuring offer that can be tailored to the different bond series and choose among different voting rules to get the proposal approved. Okay, and those are, as a reminder, the two voting rules that are going to be relevant for our analysis. Under two-limb aggregation, the restructuring offer goes through if it is approved by at least 2/3 of the principal amount across all series, and if within each series the offer gets at least 50% of approval. Under the alternative method called single limb, the restructuring offer goes through if it is approved by at least 3/4 of the principal amount across all series. You don't have any minimal consent requirement within series, okay? But you have an additional constraint that you need to give the same restructuring terms, more or less, to the different bond series. That's the so-called uniform applicability condition, okay? So when you see this, the obvious question is, should you use two-limb or single-limb? There was a lot of excitement among policy makers during the drafting of those enhanced CACs with the introduction of single-limb that was viewed as the killer strategy, okay? But for the first time, enhanced CACs were put to the test. That was in the summer of 2020 in the context of the restructuring of sovereign bonds by Argentina and Ecuador. And in both cases, the governments opted for two-limb aggregation, making differentiated offers across series. Okay, so the obvious question is what determines the optimal aggregation method? Okay, there is another motivation closer to us in the euro area, which is like since 2013, public debt securities in the euro area, they incorporate collective action clauses in the form of two-limb CACs, okay? And there's an ongoing project, it's not yet ratified, but it may soon be enforced, that will replace two-limb CACs by single-limb only, okay? And is it a good idea, okay? It would be a good idea if it was always the case that single-limb dominates two-limb, okay? But as the Argentine and Ecuadorian example suggests, it's not going to be the case, okay? The last motivation, and that's a bit down the line, and we have something to say ultimately about that, is the anticipation of the optimal use of collective action clauses by the sovereign at the time of the restructuring should affect the pricing of bonds ex ante. Some empirical studies have looked at those effects, but we will have a model that gives us some fine predictions about what we should find in the data, because any price impact relies on how exactly the use of CAC plays out at the time of the restructuring. Okay, so our contribution in this paper is simply formulate, okay, and solve the optimization problem of the debtor government, single limb or two limb. What's the optimal restructuring approach if I want to restructure my different series of bonds at minimal cost? And then maybe I will have some time to say about the second part of the paper, where we go a bit beyond this very partial equilibrium optimization analysis and look at some equilibrium model that allows us to analyze the impact of CACs on the bond market equilibrium, and in particular on the pricing of the bonds. Okay. So I'm going to start thinking about the optimization problem of the government at the time of the restructuring in a very simple context where there are only two bonds to restructure. Okay, that's the obvious starting point if you want to think about aggregation across different bond series. There are lots of interesting questions that arise when you have more than two bonds. We address them in the paper, but in presentation I will stick to the simple context. There are two bonds, H and L, that you want to restructure that will differ in two respects that will become clear in a second. The government puts forward a restructuring offer, and you want to think of it as recovery rate per unit of face values for each of the two bonds. That's WHWL, 80 cents on the dollar for one bond, 70 cents on the dollar for the other, for instance. Bondholders, they will have heterogeneous reservation values. They will compare the offer that is addressed to them to their reservation values that may differ because, well, bondholders differ across many dimensions. They can have different discount rates, different information, different balance sheets, different litigation skills, different regulatory constraints, etc. Okay, so given an offer WI made to bond I, those that will accept are those whose reservation value is below WI. We call this Fi of WI. Fi is this increasing function. Okay, the better the offer, the greater the consent share. That goes from 0 to 1, and the consent share as a function of offer depends on the bond because, and here, like I take it as given this cross-bond heterogeneity. Later, I will sort of endogenize it. But the idea is that bonds that differ in terms of the financial terms, they can have different maturities, different coupon rates, and they have different bondholder bases. Okay, so that's the source of this cross-bond heterogeneity. So to fix ideas, I will assume that the holders of bond H, they have higher reservation values. Okay, that's the first source of heterogeneity. What this means is that for a given offer, the consent share that you attract on bond H is smaller than the one you attract from bond L. In other words, if you want to attract a certain level of approval, okay, you need to make a bigger offer to bond H than to bond L. Okay, so that's the heterogeneity across bonds, and that's one of the key building blocks, if you want, of the analysis. Then the analysis moves on to the formulation of the government's problem. The government, at the time of the restructuring, wants to restructure those two bonds at minimal cost. So it wants to minimize the restructuring payouts, and essentially that's equivalent to minimizing the average recovery rate. And here, like, it's a weighted average because naturally, like the total face value of the two bonds matters. Lambda is the relative size of the bond that is more costly to restructure in the sense that you have those bondholders that demand more, okay, to be satisfied. Okay, so you want to minimize the average recovery rate under some constraints that depend on the voting rule that you're going to choose. Under two limb, you need the average consent share, and again, it's a weighted average, okay, that is greater than the aggregate threshold under two limb. Think here 2/3, okay, and at the same time, you need to get 50% approval or approval rates above a certain threshold tau 2s in general within each series. Okay, and the single limb, well, you tie your hands to not differentiating the offers across the two bonds, so you have uniform applicability, and you need the average consent share to be greater than a certain threshold tau 1. Okay, In practice, okay, you will never want to have here in this environment. I assume that the government knows those consent share functions. So it knows if I make this offer, what is going to be my consent share. That's a simplification. The idea is that during the preliminary talks with bondholder companies, you sort of start understanding how much like your creditors want. So in this case, where there's absolutely no uncertainty, you're going to bind this constraint, okay? And here, like, you're going to bind the aggregate constraint under tooling. Okay, so in a sense, that's the problem we're after. Okay, that's very micro in nature, but we think it's important just to understand what determines the optimal restructuring approach, and we're going to characterize it as a function of the relative sizes of the two bonds and the heterogeneity across the two bonds that is captured by the differences in those consent share functions FH and FL, and of course, as a function of the thresholds that enter into the formulation of the problem. Okay, so I'm going to look first at the two-limb, the optimal offer and the single limb, then about two-limb, and then I will talk about the optimal voting procedure. Okay, so in the single limb, it's very easy in a sense. You don't have much room to maneuver. You are going to choose the recovery rate U star that gives you an average consent share equal to the threshold you need to reach. Okay, and naturally the consent share for bond H is going to be below that for bond L. Okay, and how generous you are going to be with your offer depends on the relative size of the two bonds. Okay, so this is a case where the expensive bond H is relatively small. If I increase its size, well, the overall pool looks more like bond H, and you need to be more generous in order to reach a certain threshold. And you see that in that case, actually, you have increased, of course, the consent share of bond H to the point that the consent share goes above the series by series threshold that is relevant under the two-limb procedure. So in that case, in a sense, the single limb method doesn't bring you anything because its unique advantage is to get rid of the series by series constraints. But here, in order to reach the aggregate level, you are not going to violate the series by series constraint. So it already tells you that in that sort of situation, single limb serves no purpose. Okay. So when you want to think about the optimal offer and the two-limb aggregation, the problem is less degenerate, is a bit more subtle, although it's still very simple. You want to first think about this auxiliary problem where you just want to minimize the restructuring payout subject to this aggregate consent constraint. Okay, so how can I reach an average consent share of tau 2A while minimizing my average recovery rate? Okay, that's a well-posed problem under some technical conditions. The auxiliary solution, the solution to this problem, I call it WH hat, WL hat. I can fully characterize it as a function of the two conditions it needs to solve. I'm not going to go into the details of why those conditions are there. But what's clear is that if the solution to this problem happens to satisfy the series by series constraints, okay? So if the implied consent share for each of the two bonds is greater than 50%, well, clearly that's the optimal offer to make under two-limb aggregation. It can happen, however, in particular that for bond H, this auxiliary solution would violate constraint that the consent share FH of W hat H is greater than 50%, in which case the series by series constraint is binding. Okay, and in that case, you would just set the offer to bond H in such a way to satisfy the series by series constraint on that bond, and you would choose the offer to the other bond to satisfy the aggregate constraint. That's what this says. Okay, so we understand how to use each of the two voting methods separately. And then we have a very simple sort of remark to be made about the optimal voting rule. Okay, what's sure is that two-limb is going to dominate if any of those two conditions holds, and they may well hold both at the same time. If the auxiliary solution I was just talking about satisfies all the series by series constraints, or if the optimal single limb offer satisfies all the series by series constraints, okay, then two limb is going to dominate, because that's a situation where, well, here you don't need to get relief on the series by series constraint because they're not binding. And here, if you use single limb, you're not going to use that unique advantage. So in both circumstances, the unique advantage of single limb serves no purpose, and you're only going to tie your hands to not differentiate offers across the two bonds. And maybe, as it is in practice under the standard enhanced CAC versions, your aggregate threshold is going to be higher at 3/4 instead of 2/3. Okay, so why would you use single limb? Well, you don't want to use single limb in those cases. Okay, so those were sufficient conditions. In the paper, we go beyond that. Okay, we characterize those sufficient conditions analytically in terms of the fundamentals of the model, and we also go all the way to characterizing necessary and sufficient conditions. And here I just represent them graphically in a particular parametric case where we control the shape of those CDF of reservation values, or like the constant share functions for the two bonds, by a parameter that tells us that it's higher for bond H than for bond L, to capture the fact that the bondholder base is more demanding for that bonds than for the other. And here, like what you see on this picture is as a function of the relative size of bond H and the degree of heterogeneity across the two bonds, when is it that you're going to use one or the other of the voting method? And so what you see is that in all that region of the parameter space, two limb dominates, and that's when the hard to restructure bond is relatively large, or when there is relatively little heterogeneity. That's the case where I give the maximum chance to single limb because I set the aggregate threshold under single limb to its level under two limb. If I increase, as it is in practice, the threshold level under single limb, I shrink the region where single limb dominates. Okay, but the overall picture is that single limb dominates if you have a bond that is much more demanding than the other and that is relatively small in the restructuring pool. Those are the insights, okay, from the analysis of the problem. So just to give you the flavor of the second part of the paper, we move to an equilibrium setting. It's set up in continuous time, but and there are some technicalities that I will skip over. You have a continuum of risk-neutral investors that now we are explicit about how they differ, the different investors, and they differ in terms of their discount rates that are distributed according to this CDFG on some interval R min R max. And there are two bonds now. We are specific about the sense in which the two bonds are different. We call them S and L. S for the short-term bond, L for the long-term bond. And technically, they have different decay rates, and the decay rate for the short-term bond is higher than for the long-term bond, and that's the sense in which it is a short-term bond. And they may have different coupon rates, okay? And they have different relative phase values that are constant over time. And you have this exogenous probability of restructuring with some arrival rate or arrival probability eta, okay? And the setup of the model is that at the restructuring stage, the reservation values will depend on the bond we're looking at and on the discount rates of the bondholders. Okay, and so bonds that have higher coupon rates, holding everything at constant, will have higher reservation values. And here, this functional form is such that only the more impatient bondholders will accept a certain restructuring offer. Okay? Prior to the restructuring, looking ahead at the possibility of a restructuring and the offers WIs that will be made at the restructuring stage, each bondholder has his own subjective valuation of the bonds. Okay, that depends on its discount rate. Okay. And at that prior stage, which we call the sorting stage, the bondholders that are heterogeneous in their discount rates will choose which bond to hold. And that will depend on how like their subjective price differential or valuation differentials compares to the market price differentials, okay? And so we have a partitioning of the entire universe of bondholders into those that will go into bond S, the short-term bond, and those that will hold the long-term bond. And given this partitioning, okay, you can express the share of investors who want to hold bond I, okay, each of the two bonds, and you have that emerges endogenously in this context, the distributions of reservation values for the two bonds that differ both because the bonds have different payment terms and because they have different bondholder bases. Okay. It's nice to think about the notion of equilibrium in this context. The equilibrium consists of a price differential and a partition in the sorting stage and in the restructuring stage, a modification method chosen by the sovereign and restructuring offers, such that, well, everybody optimizes, okay, so does things optimally, both the government and the investors, and then the market clears, okay? So just to give you a further sense or flavor of what can happen is we're going to consider a parameterization of these environments where the short-term bond is held by more impatient investors, okay, those with discount rates higher than the threshold. The threshold has to be such that market clears, okay, and you end up with this partitioning of the universe of creditors where the more impatient ones hold the short-term bonds, okay, and that's the reservation value as a function of the discount rate. So for the short-term bond, for instance, the reservation values will be in that interval, whereas they are in that interval for the long-term bond, and you get the things that were taken as exogenous, endogenously in equilibrium, which are those CDFs or constant share functions. Okay, and then you can redo the analysis we're doing in the partial equilibrium context. You can solve for the optimal constant shares, the optimal offers, and the optimal voting procedure, which in this case is to use the single-in procedure. And then you can do comparative statics, change the degree of heterogeneity in terms of payment terms. Here, a decrease in the coupon rate of what happens to be the expensive bond in this parameterization, which is the long-term bond here. And you can look at the impact of a change in the relative sizes of the two bonds. And there is something subtle that happens here, is that when you change the relative size, you also affect the degree of heterogeneity. You affect the reservation value distributions. I will not go into that detail. And then you can look at the effect of a change in the specification of CACs on bond prices. Okay, so that's it. We, I think, clarify the trade-off between the two aggregation methods with that analysis, showing that single-in can be optimal when a relatively small bond in the restructuring pool is held by tough creditors. I showed you the two-bond analysis. We can extend to n bonds with uncertainty. Okay, so that's interesting to tackle issues of sub-aggregation, resignation, exports, bonds with different versions of CACs. Okay, then we have this equilibrium version of the analysis where the bond-specific reservation value dispersions arise endogenously, and of course there's more to be done. In particular, I think it would be interesting, and that's out of the model, to think about one use of single-in, which is as a deterrent of non-atomistic vulture. Okay, and that's interesting because it could be the case that ex post in equilibrium single-in is not used, but off equilibrium it serves as a deterrent. Okay, so I think this we want to think more about it. Thank you very much.
That only this is a fascinating paper, and you have to blame it all on me because I took too much time to the discussion of the first paper. But in order to have some time, if 4 questions, if needed, be over lunch, I want to give sufficient time to the third paper, so we'll go straight into it, and then we'll have whatever questions we have before we move on to the next session. So let me just introduce very briefly. Elya Zhang is a research associate of the Asian Studies Center at the University of Pittsburgh. She has a background in history, and she's a confessed map lover that has designed 8 different courses, systematically testing the integration of scientific map making into historical research. Her paper is Modern China's Three Sovereign Defaults and Legal Endings. And she has also distributed a handout, and she goes, in some detail with the Jackson case. We will have that as an addition.
So I have a handout here, and if anyone who hasn't gotten it.
Very interesting historical analysis of the Jackson case.
Anyone read that?
Anyway, so the floor is yours. Thank you very much for being with us.
Yeah, thank you, Dr. Lastra, and thank you so much for being here. So I prepared a handout because we're talking about history and we're going down the 100-year-long rabbit hole here. So I hope that can help us to keep in check. So I'm a historian, and then I studied history of Southern that. And today I would like to talk about the story that when China actually owe everyone money and didn't pay back. And that was before 1949, yeah. So we'll start with the most famous loan in the history of China's sovereign borrowing. You probably saw this piece before. It's on many websites. This is the 1911 Huguan Railway bond. And so it was significant. It was actually not a big amount, just 6 million pounds floated in 4 countries. But it was the loan because, 6 months after this loan was floated, the imperial Qing dynasty just collapsed. And then this loan triggered the railway recovery movement, which triggered the Wuchang uprising, which brought down the dynasty. And then another one is this one was well known because many years later it became the subject of a famous lawsuit. It's Jackson versus the PRC lawsuit. So I'm going to briefly talk about, I think there are many legal experts in this room. I'm just going to briefly talk about, this famous lawsuit. Can people in the back hear me? Am I loud enough? Okay, great, thank you. Yes. So the Jackson trial. Yeah, the Jackson trial is very simple. It's in year 1976, this forensic engineer, and then called Russell Jackson, and he was reading a Barron's article, Barron's magazine, and then he saw this article said, like people who hoarded the pre-war Japanese bonds and German bonds, and they make a fortune. Yeah, because later this countries come to settle. So then, Jackson looked around and he said, let's see, what major country that look promising that we don't have a diplomatic relationship yet? So he found China. So he started to call, brokers, look for old Chinese bonds. And then he found the Huguan bonds. So he put $10,000 in it. And then he also brought his wife, his nephew, a total of 6 people in the Jackson family. And then they hoarded a bunch of them. And then they patiently waited for Jimmy Carter to recognize Red China. So when Carter recognized Red China January 1st, and then Jackson waited another 11 months and didn't see anything mentioned on the settling. So he sued. Yeah, he brought PRC to court. Surprisingly or unsurprisingly, yes, 2 years later, the Alabama judge actually ruled, said the PRC had to pay. Yeah. People's Republic of China has to pay $41 million. And this is according to Wall Street Journal. It's like will make the Jacksons rich beyond imagination. But there is some scary global implication here because the bonds were floated in 4 countries. And this is just simply American case. Yeah. And then we're talking about German compensation, French compensation and all this. So that's why the Jackson trial became the very first trial that subjected the PRC to an American court. And this is why I view this as a landmark event. This is the very first time the PRC came out of the post-war shadow and then have to essentially answer for its predecessor's debts. So later development of the Jackson trial, long story short, is final in the end, the judge ruled in favor of the PRC. The PRC has 3 kinds of defense. The first one, it says that the FSIA, cannot be applied retroactively to the 1911 bond. It's actually just missed by 1 year because the FSIA retracted back to a tape letter in 1952, and then Huguan law happened to mature in 1951. Okay, so there's a 1 year gap there. This is what we call historical incidental there. And then the second one is also China brought out the argument of odious debts. Yeah, and then the third one is also Alabama law also has a statute of limitation. So when we see the later development, of the trial, and so we can see that the first one is in 1984, the Alabama court dismissed the claims of the plaintiffs. And later, the Court of Appeals, they also ruled along the same line. The final nail on the coffin, is the U.S. Supreme Court in 1987, and then they denied a hearing of the case. In other words, the Supreme Court is not going to pay attention to this case. So this, in my opinion, marked the end of this trial in the American judicial system. So another thing that is the Jackson trial was a very high-profile trial. It involved, actually the diplomatic negotiation between two countries. But there's something that only later we find out, 30 years later, find out when people started to talk. And then that is the Jackson trial also triggered another thing. Is like this is sometimes we say, when you see a duck swim, you don't see the legs, beneath the water. And so that's exactly what PRC was doing there. Is in the proceedings, through the proceeding of Jackson trial, the PRC started a systematic source hunt. In other words, is that the Jackson set precedent, and there are hundreds of loans out there, and nobody knows what are those. So the PRC, the State Council, they launched a multi-ministry effort. And then as you can see, they mobilized a team of 80 people, full-time researchers, and they worked 5 years. They essentially went through every single piece of archives they can find. Collect all pieces and try to compile the most comprehensive record to date. Today. This is for, you can see this is for legal, this is a part of a trial preparation that was quietly carried out in mainland China that was not known to us until many, many years later. So after the trial ended, when the Jackson trial ended, we also see, in the China part, the sources became public. See, I'm a historian, so I'm paying a lot of attention to source. So in this case, the source hunt itself became part of history. The source hunt itself was a historical landmark because the PRC, they launched this project. And then they got to the point by 1989, they feel comfortable to actually completely open it to the public. So the sources here is everyone can see, during Chinese. There are 47 volumes, 13,000 pages, 8 million Chinese words, and then have, loans small, big and small. It's wide open, with the state stamp on it. In other words, if anyone actually want to sue, the sources are right there. The evidence has been open. So then when we look at this, so this is my research. This is what I do, is I read through the sources there. I read through the sources here. And then exactly, what was China's foreign borrowing. So specifically, we're talking about 733 loans, big and small. There are billion-dollar loan like the land loan, or there are also a loan of 432 pounds, which is the ticket expense of the Chinese military officer, during World War II, through the English Strait. So that's also tiny things like that. As well, all these are included. And it was taken through 96 years. And then it was between 143 Chinese borrowers and then 231 foreign creditors. The total is roughly 2 billion, and then more than half repaid, were not repaid by 1949.
1853 goes to
1949.
Yes, but you stop there because
I stopped there because the default is going to hit, the communist is going to default the loans. So
you start in 1853. Why?
Oh, starts. That because that's the very first foreign loan that China took. At the time, it was during the Taiping Rebellion, taken from American merchants to suppress the Taiping Rebellion. Yes. So, when it comes to Chinese sovereign, it's very, very broad. You can see the state has, has no stone unturned. So it essentially examines everything, including Chinese National University. That's why you see that tiny loan as the unpaid salary of foreign professors in Beijing University. It's also counted as part of sovereign loans, sovereign debts. So when we look at this, how do we try to have some periodization of this? The way I look at it is, let's look at sovereign defaults. When there were loans, there were defaults, and China was no exception. So when we look at the history of, of China, there are 1, 2, 3. There are 3 defaults. The first one is 1921. And then the second one is 1939. Yeah. And then the third one is 1949. So due to a constraint, I'm going to quickly go through it. We can take the first one, the central government defaulted a loan due to corruption. They simply just borrow beyond their means. Yeah. And then the result is there was a loan embargo in China throughout the 1920s. That's why, when we talk about the global debt crisis is the Great Depression, you will see the Latin American country, German, you don't see China there because China was blanked out that decade. And then the second default is 1939, and that was due to Japanese invasion. The Japanese simply took over 2/3 of China, and then the nationalists lost almost the entirety of this revenue they cannot pay. But this one, the last one, that was the key one, 1949, and those are the most well-known one. Yeah, this is the time that the nationalists already lost mainland to the communists. So now the nationalists in Taiwan and then the communists in China. Both of them, almost simultaneously, they declared sovereign default, on both straits of China. So the immediate cost is, the first one is the nationalists took all the gold to Taiwan, and then the communists have mainland China, but they only have empty vaults. Yeah, all the money have gone. And then the second one is also this, again, history is full of, contingencies. The contingency is that the U.S. state, the U.S. State Department at the time, in order to answer the public question is why we lost Red China. And then so they publish a 1,000-page China white paper. And then at the end of the white paper, they have a table and say how much money they're trying to borrow for us. And then so when the communists took a look at the book, and then come to page 781, and then they see $1.1 billion. That's more than their 2 years of income. So you can imagine, it's almost like knee-jerk reaction, the communists just declare sovereign default, yeah. So the consequence is that the PRC was cut off the international market essentially for the rest of 30 years. Yeah. So now, there was one curious observation in hindsight is that when we talk about China's past debts, it's almost like one and the others. Everyone knows about Guibaud, the Jackson, yeah. But then what about the other 732 loans? They were under the radar. Or, the question is, why weren't there more lawsuits for the rest of the 20th century? Why didn't anyone else sue? The evidence are right there. It has been in open since 1991. So this is the question that I would really like to seek your opinion, toward the end of this session. So I try to answer this question. Is that why? And then the way I look at this is that let's look at what are those debts, yeah. So I took two approaches to look at these debts. One is by type, yeah, the type of debts. And then so there are debt securities, loans, accounts payable, miscellaneous dues, and unsettled reward aid. This part is the elephant in the room that if the American government decides not to pursue it, then it's gone. Yeah, so. But then the debt security, in other words, public floated treasury bonds are the most likely one to trigger litigation. But in the handout I gave you, yeah, and so I list all of them, and then you can see that in the end, so most of the bonds were floated in London or in Paris, so that if the British government and French government decide not to pursue it, then there will not be litigations. So this is one way to look at it. Another one is just to look at by creditor nation. So yes, it was a lot of money, but the United States lent, more than all the other countries combined. First, out of the 17 nations, there are 7 major nations, and out of the 7 majors, you have the giant, the American portion, and then Japan, Britain, Germany, France, Belgium, and Russia. Yeah, there. So that's why if we look at the country by country approach, let's look at these countries. Yeah, let's look at these countries, and then each of these countries at some point you will see they put a closure to it. Or in other words, they chose not to pursue it. So we'll start with the USSR. Yeah, the Russia, USSR. So the Russia, as early as 1917, the Bushwick, when they have the Bushwick revolution, they on one hand, declare sovereign default. but they also canceled, as a revolutionary act, they also canceled the remaining Chinese debts besides Russia. And later, after 1949, China did borrow, but China cleared that debt in advance, So that ends the Russian story. The Belgian story, Belgium was actually a major creditor too, and then it was not mentioned. So by 1979, the PRC actually received its very first interest for a loan from the Belgians. The Belgian actually is the very first to offer interest-free foreign loans. So this is unincidental. There was the very first one. And then Japan, Japan allowed, China to float its first treasury bonds, treasury bonds in the foreign currency in Tokyo. And then France here, in year 1984, the BNP offered the first bio-loan agreement, and that sort of ends the French story. And then West Germany, in 1985, PRC floated its first Eurobond denominated in the Deutsche Mark, in the German mark. Then that leaves the United States and UK, the two biggest creditors there. The United States, we already know the Jackson trial. After the end of the Jackson trial by 1987, the PRC floated its very first dollar-denominated bond by 1987, and that leaves the UK. So in the end, out of all the countries, the United Kingdom is the only one to get money from some money, from the PRC. So that ends the story of the 7 major creditors. By year 1991, confident, PRC is confident to say that China started afresh as a sovereign borrower. First, they already floated bonds in all the major capital markets. And then the second one is even the World Bank, unfroze the China loan, because after 1989, the Tiananmen movement, the World Bank actually froze the loan. But then by 1991, they unfroze it, and continue. And meanwhile, from the source time point of view, this is also the year that the state confidently let all the sources out. Let all the sources out there. I'm almost there. So, so why we're still talking about it? Because they're still making headlines. Almost every other week, I will see the headline, the U.S. headline, at least, especially in the United States. So even though, there was no other litigation for the rest of the 20th century, but then in the current century, especially after China joined WTO in 2001, the ghosts just come back. The ghosts of Chinese bonds, they come back. To start with, in 2001, there was established a foundation, slash company, with the sole purpose to make China pay. They stated on their website. And then the second one is this one. There was another lawsuit, much less known in 2005. So another American citizen tried to go after the PRC. And this time it's for the 1911 reorganization loan. If you go to the back of the handout, the very last, the last treasury bonds there. And it continued, the ABM mobilized, the US congressmen, and then you're going to get kicked out of this. It's like in year 2013 and 2014, there was even this Houston megachurch pastor who oversaw like 14,000 followers, and then he squandered $3.5 million of those investor, and under the pretense that you are investing in, pre-49 Chinese bondholders who's very rich. And then the SEC found out, took the scammer to court, and then the SEC came out to issue a statement, and say, no, these bonds are mere collectible, mere collectibles and no investment values there. So that comes to my, purpose and conclusion here. It's like, I would like to seek opinions, from the legal experts in this room. Is that, can we put an end? Can we put a legal end, to the pre-1945 defaults here? So my opinion, I would say yes, and because, the Russian, Japanese, Belgian, French, and German portion has been the non-issue. And then the British portion had been settled. And then the American portion, at least the treasury bonds one, has been addressed in court. And so the elephant in the room, the ward A, the land lease still remain unsettled, but it's complete another story there, yeah. But this is just my personal opinion. So that's why I would like to, ask the experts in the room that, how should we, what do you think, on this question? Thank you.
Thank you so much. Only a good paper for the next presentation, in fact. However, exceeded the time. He told me I can have 5 minutes, or at least to give proper tribute to the 2 excellent papers. Let's collect a couple of questions for each of them and then just answer. Yeah.
Thank you for this meeting. You said that, beginning of your story, the Jackson trial, you said the US court threw out the case because the foreign immunity 1976 didn't apply retroactively. This is interesting. Also, you said China bore no responsibility for odious debt, quote unquote, odious debt. This is in your PowerPoint. I was wondering if you had found this term, odious debt, in the legal documents that you had access to, from the Jackson trial. Is it something that if you found it in the document, it would be very meaningful?
Yes, and then so we can talk after the session. I can try to show you. So it was actually in the court documents that I read, and they used the term odious debts. Yeah, actually they used that. And then so yes, and so it was by the time, and then because suppose FSIA can be retroactive in 1951 and 52, and then the Huguan bond matured in 1951. So they were actually seized by one window to get a case. So in other words, the Alabama judge essentially is not talking about pay or not pay. They just try to say whether you can even sue or not sue. Yeah, and then they were based on that technicality there.
Yes.
My question is for Stéphane. So I have 2 short questions. So first of all, if I understand well, you find that the actual aggregation rules can impact the pricing, at least in your model of the bonds. But isn't it that most empirical studies, if not all, find that there's actually no pricing difference? In the data. And then second, what would your advice be to the euro area's proposal of having this single limit only? Would you say, well, it's better to go with this type of enhanced tax where you at least have the choice between single limit and double limit, because in some areas it may actually be better to double.
Yeah, so for the second question, you gave the answer. Yes, from the point of view of the expert perspective of making restructurings more orderly and timely, clearly they're giving the option. It would be a short option between the 2 aggregation rules. That would not be the case if single limit was always better than 2 limit, but as we show and as the Argentine and Ecuadorian cases bill, that's not the case. So I don't know what's the story there, why they decided to move to single limit only instead of adding this as a second option. And then regarding the empirical study, the results are a bit all over the place. It depends on the context. There are a number of papers on this. Mitugulati with Carlo authors and some IMF studies, which actually show that more softer tax in the sense that they give more room to the sovereign to maneuver exposed. They rather tend to be associated with lower yields, higher bond prices, if anything, which alleviates the concern that softer tax would create more hazard issues. But what I think is that the model would predict some finer, we'll have some finer predictions, and actually that's why I like to think about how those aggregation rules play out exposed before going to the data, because you want to really understand finally how they play out, to know what you need to be careful to look at in the data. So I think there's more to do actually in the pricing impacts.
Because that's the main concern why it's not been adopted yet, because they think it will Give a signal that there may be a debt restructuring coming forward.
Yes.
That's why the Italians basically are talking.
So, yeah, so our model is only going to go so far into addressing all the questions. At this stage, we have exogenous arrival rate of restructuring, so we can't take a stance on like there's no force for more hazard, so we can't go all the way to thinking about the optimal design of collective action clauses, which of course is an exercise that would be well known.
Thank you. The last question, Frederic. Oh, Frederic and Anna. Yeah.
Thank you very much, Stéphane, for the paper. Have you considered introducing in the model also the variable that the sovereign may choose which series it will include, and how that would play out?
Okay, absolutely, that's a very good point. So most of the analysis focuses immediately on this two bond case. So with two bonds, if you want to talk about aggregation, you need to keep the two bonds in the restructuring parameter. If you have end bonds, clearly like that's something that becomes relevant. So sub-aggregation is also like thinking about which bonds do I leave out of the restructuring pool. There are some considerations in practice that are clearly very far from the analysis, which are more like political economic considerations. If I may mention here, like holding a lot of that bond, maybe I want to keep it out of the restructuring parameter. So that's another consideration. But at least in terms of thinking about sub-aggregation with end bonds, that's something we can do.
Thank you. And then the last question, Anna.
This may be the nature of a comment, but have you thought about the two different versions of the two-win? One in which each series has a veto power, and the other where the dissenting series just drops out.
Yeah.
What difference does it make?
Absolutely. So that's a very good point. We've thought about that. So there are different things to say. So here, like we in the simple environment, there are two bonds. You want to restructure both of them. You want the offer to go through, and so you want to reach the consent share within series in both theories. Yeah, and you can do that because we assume that you've learned enough about the reservation values of the bondholders that you can tailor the offers so that's to satisfy both passive and series constraints. In practice, you don't. So we have this extension where there is some uncertainty. You don't know even the offer what is going to be the approval rates. Okay? And then we need to think about the two types or the two interpretations of the two aggregation with resignation ex post. So we do that in that extension with uncertainty.
Well, thank you very much. And with that question, we just finished this session. And in the customary way, our thanks to the three wonderful papers.